In November 1956, the world's proudest empire discovered something terrifying. Its power no longer came from warships and flags, but from borrowed money. For over a century, Britain's merchants, bankers, and admirals believed the red on the map would never fade and the pound would never be questioned. Yet in only 11 days, that confidence evaporated. One sudden financial shock proved an empire can fall without a single shot at its capital. A quiet phone call from Washington, more powerful than any cannon, ordered Britain to stop its invasion or watch its currency collapse overnight. The message was simple and brutal: end the war, or we crash your pound, freeze your lifeline loans, and let your economy burn in real time. To understand how a single ultimatum could bring an empire to its knees, we first have to understand the fragile foundations it was built on. In the 1800s, the pound was the default language of money. If nations traded or saved, they usually did it through London's powerful banking system. This privilege felt almost supernatural. Britain could borrow cheaply, print freely, and run deficits while the rest of the world begged for its currency. But across the Atlantic, smokestacks and railroads were rewriting the future. A new industrial giant named America was quietly overtaking Britain's real strength. By the early 1900s, US factories outproduced British ones, yet the world still clung to the pound out of habit, convenience, and old financial plumbing. World War I forced Britain into a terrible bargain. To defend its empire, it financed the slaughter with mountains of debt it could never truly unwind. By 1918, the empire once lending to everyone was now borrowing from almost everyone, especially from a rising, cash-rich United States across the ocean. Instead of shrinking its ambitions, Britain chose denial. Leaders pretended nothing fundamental had changed and kept spending as if dominance were guaranteed. In 1925 they doubled down on pride, locking the pound back to gold at an unrealistic pre-war rate, as if the damage simply never happened. To defend that overvalued pound, interest rates were pushed painfully high, choking businesses and pricing British goods out of markets they once easily owned. Even as unemployment rose and factories slowed, the empire kept its global bases, its expensive image, and its illusion that prestige could pay the bills. Speculators read the math more honestly than politicians. They saw a country overspending, overpromising, and quietly sliding toward a currency confidence crisis. In 1931 the dam broke. Britain had to abandon gold entirely, and the pound suddenly lost almost a third of its value in a brutal adjustment. Yet the currency survived, not from genuine strength, but because colonies were still forced to save in pounds, propping up London like financial hostages. From India to Africa, reserves were stored in sterling, turning Britain's own empire into a life support machine for a money system already past its peak. When World War II arrived, Britain repeated the same pattern: borrow heavily, spend boldly, and hope tomorrow's growth would magically pay yesterday's bills. By the end of that war, Britain owed more than its entire yearly output. On paper it looked mighty, but financially it was quietly bankrupt. Still, its leaders clung to the old self-image, acting like managers of the world rather than a debtor who now depended on Washington's patience and credit. So when Egypt nationalized the Suez Canal in 1956, London treated it not as a warning from history, but as an insult to its fading pride. British forces moved in with confidence. On the ground they were winning, retaking positions and advancing quickly, convinced that military success meant overall control. But far away in Washington, America saw something different: a reckless colonial throwback that risked pushing newly independent nations toward the Soviet Union's embrace. The response was an economic gun to the head. Withdraw from Egypt, or we sell your currency, block your IMF loan, and trigger a financial heart attack. Britain's foreign reserves were draining at over $100 million each week. Every day of defiance made bankruptcy more certain and humiliation more inevitable. Under that pressure, Prime Minister Anthony Eden had no real choice. He ordered a ceasefire and retreat in exchange for continued access to emergency financing. Suez lasted only 11 days, but it tore away the mask. The world finally saw Britain not as a commanding empire, but as a debtor on borrowed time. Now switch the names in this story. Replace Britain with America and pound with dollar, and the pattern suddenly feels uncomfortably familiar. After World War II, Britain's debt to GDP soared above 200%. Today America's ratio has climbed past 120% and keeps rising. Britain strained to maintain far-flung bases it couldn't afford. America now funds hundreds of installations worldwide and spends more on defense than the next 9 nations combined. Where Britain once forced colonies to hold pounds, America built a petrodollar system where most oil deals run through dollars, backing its currency with global energy demand. But major economies are experimenting with other paths. BRICS nations explore trading in their own currencies, slowly building an escape hatch from dollar dependence. Meanwhile, projections show U.S. interest payments crossing $1 trillion a year around 2026, more than America spends on defense or Medicare individually. That is when priorities quietly flip. A nation's first obligation becomes servicing creditors, and its political choices shrink to whatever the bond market will tolerate. The trigger could be a messy war, a debt ceiling showdown, or a sudden loss of confidence in U.S. bonds. But any of them could become a modern Suez moment. Overnight, the country used to setting terms could find itself taking instructions from those who hold its debt, just as Britain once did with Washington. For ordinary Americans, that shift wouldn't feel like theory. It would hit in grocery aisles, at gas stations, and in monthly payments on homes and cars. When a reserve currency loses trust, savings erode, imported goods explode in price, and people discover that their paycheck suddenly buys far less than before. The comfortable suburban lifestyle so many assume is normal, cheap credit, full shelves, stable prices, can fade within a single generation, just as it did in post-Empire Britain. Britain wasn't destroyed by enemies storming its shores. It was undone by its own decisions to overspend, overborrow, and delay hard choices until they became impossible. America is now running the same experiment, betting that its history, technology, and military power somehow exempt it from the simple arithmetic of debt. But history doesn't care about slogans. It only respects balance sheets, interest rates, and whether creditors still believe you can and will repay what you owe. The real debate, then, isn't if a reckoning comes, but when, and whether it arrives gently through reform or suddenly through crisis like Britain's Suez shock. In every collapsing empire, those who trusted governments blindly suffered most, while those who quietly diversified and prepared had at least a chance to stay afloat. Britain's chance to change course closed slowly, then slammed shut. By November 1956, pride had already used up the last of its financial breathing room. America's window is also shrinking as each new trillion is added. Whether 2026 is the breaking point or not, the direction of the numbers is unmistakable. So when the modern version of that Suez phone call finally comes, the real question will be, will America still think it's too big to fail, or start acting before it does?